Welcome to your Daily Five. I am your host, Bruce Fraser. Today, anatomy of a bear market. And we are going to broadcast this on May 24th, but it was recorded over the weekend on May 21st. So we have not seen Monday's market activity. Just keep that in mind. You'll see that it probably is not real important day to day because we're going to look at the structure of bear markets. And from that, we are going to have hopefully a roadmap for how a bear market might unfold. And also, is it possible that this is in fact a bear market? First, I'd like to invite you to attend our Wyckoff Market Discussion 300th episode. This is going to be an event. It's this coming week. It's actually tomorrow, May 25th, and everybody's invited, absolutely free to attend, no charge. We don't share your information. Go to Wyckoff Analytics to register for this event and to learn more. You can click on that box there in the middle to learn more about the Wyckoff Market Discussion Series. Every Wednesday afternoon at 3 p.m. Pacific time, you see the blue button at the top of the page. That is a link that takes you straight in to registration. And the website again is wyckoffanalytics.com. Also, had a great guest this past Friday on Power Charting, Roman Bogomazov, my teaching partner for nearly 30 years, incredible Wyckoff analyst, educator, all around great Wyckoffian. We have a discussion on current markets, the Wyckoff perspective. So please check it out. You can watch it on demand. Go to StockChartsTV.com, click on the power charting page. It's right at the top. Okay, anatomy of a bear market, 3 case studies. So let's go back and look at historic bear markets and put them into context for how things could unfold in the next bear market that we get. Is this a bear market? We'll have a discussion about that. But we'll also then, after this discussion, have a roadmap for how things can move forward. Let's look at the 73-74 bear market. This bear market could have echoes or similarities to the current environment. This was a period of high inflation. And in fact, this decline was on an inflation-adjusted basis among the worst bear markets for purchasing power loss, going all the way back to the 29-32 Great Depression event. Even though that had a bigger percent market decline, this one was substantial because at the bottom there was an extreme loss of not only the value of assets, stock prices, but also the purchasing power of the dollar at the conclusion. Here, I just want to show you that we use the percent scaling tool or the percent calculating tool on StockCharts.com. Very cool tool. We mark the high, mark the low, and it estimates the percent up or the percent down. In this case, now you'll notice this red line is above the high here. I actually do it from the intra-week high using bar charts and then converted this to line charts. So here, the high, intraday high weekly to the intraday low weekly gave us a decline of 50%. The actual calculation based on these numbers right here, high to low, 49.9, really, really close. So really a terrific tool. Now, note the distributional characteristics here at the top. After a big bull market run in 71-72, right into the election, a distribution formed classic in structure and in nature from a Wyckoffian perspective. We have preliminary supply. We have a buying climax, last point of supply. We can go in and really tear this structure apart, evaluate it, and then you can see a redistribution event here. And then finally, at the lows, an accumulation that forms, which sets up the conditions for a new bull market. This is a interesting case study, very persistent decline that went down a whopping 50% with a redistribution in the middle. And then I want to really point out the nature of the selling climax into the lows, because selling climaxes, and this is an important part of this discussion today, can persist. So keep that in mind, because you don't want to go stand on the railroad tracks and try to stop the freight train that's coming at you, because it takes miles for the train to stop. That's exactly what a selling climax can be. So now let's move on to our next example. Let's clean this up a little bit. Here is the 2000 to 2002 bear market. And here again, another classic distribution structure that formed. And here we'll highlight it, outline it. Preliminary supply, buying climax, secondary test, sign of weakness, last point of supply, big distributional structure, had a series of redistributions on the way down, and then just a persistent decline all the way down. This had a 931 calendar day high to low move of 50.5%, very close to the decline here, which took 630 days and 74 calendar days. 931 here, a little bit longer period of time, but look at the persistence along the way. This is the September 01, September 11th event, a very sharp bounce, bear market rally, redistribution, and then down into the final lows. Look at this classic accumulation structure here. Okay, and then a new bull market. Third market we're going to look at, and this is by no means all the markets. This is just to give us a sense of the possible roadmaps for how bear markets can unfold, which could be helpful to us in the future, possibly now, because we possibly could be in a bear market. Okay, so here you see 2007 to 09, the Great Recession event, classic distribution structure. Look at this. Preliminary supply, buying climax, up thrust at the highs, slightly takes out the climax peak, big sign of weakness, last point of supply, and then a pause under the ice here, as was the case here, and then downward into a markdown. Look at the persistency of this markdown. Did not get a redistribution structure until very, very near the lows, and then a final climactic V bottom low, very dramatic period in 2009. And here is, this was 511 days, shorter than the prior two. Here is our accumulation here, which set up the great bull market that started in 2009, 2010, and went on for about a decade. So quite a dramatic event. So 3 bear markets, each with slightly different time frames, very similar in their markdown construction, preceded by distribution, and then a really compelling accumulation formation at the bottom of each. Not time today to go into those, but I want you to keep those in mind. Let's bring this up to date. Now, we don't know if this is a bear market or not. As a matter of fact, sentiment's becoming quite extremely negative at this time. Inflation is high, pessimism is high, and so on. But here we have a classic preliminary supply, buying climax, up thrust at the highs, sign of weakness, last point of supply, and a distribution event, followed by a markdown out of the structure. 74 days so far. Now, keep that in mind compared to the number of days that was spent going down on high to low in the prior examples. If this is a bear market, it's a baby. It's very young in its duration downward. So keep that in mind. But again, is this a bear market? We have 3 roadmaps that can tell us how one of these things can unfold. And we want to keep those in mind as we go forward. Last thing I want to show you here as we get close to the end of our broadcast, and also do note the uptrend. Let me get my pen back here. And you can see that in the case of each one of these, you can see that there was a substantial upward stride going into the final peak. And then very important, we had a big sign of weakness, LPSY here, and then downward we went. So now a potential markdown. Is it possible because of the extreme negative sentiment that we could have some kind of a redistribution followed by another decline? Too early to tell at this point. We may have to have more weakness. Just keep in mind what I said about selling climaxes if we're even close to one, because don't try to catch the falling knife. Old Wall Street adage, let the knife hit the ground, stop moving, pick it up very carefully. That's the nature, that's the reason for that saying, is because of the nature of selling climax events. If there is going to be some kind of a rally event, we know that it will build some kind of a cause to then form a cause for a move up. So just keep that in mind. So we have a couple minutes left. And so let's look at a point and figure chart, one of my favorite things to do. And so here we have a count. This is a large structure. Could this point and figure count give us an estimation for how far down the market could go? This is a rather substantial count that I've taken of this distribution structure that's in yellow here. And this is the count line across here. I've taken the more conservative count. It's still a pretty aggressive count. Well, look, think about how far down the market went high to low. Now let's go back for just a sec. Look, we're only down 20.92% at this time. You can see that here, 21% on the estimating tool, intraday high to intraday low, weekly. And then you can see that the only 74 days downward so far from the peak, not from the beginning of distribution. So now we look at this point and figure chart. This chart, if we count across here, gives us a count down to, gives us 2,100 points of declining S&P points. A markdown already has occurred out of the structure, counts down to 2,700, which is minus 43.7 from the high, to minus 2,500, which is 47.9% off the high. So there is fuel in the tank for further decline. And so we must keep respect and keep an eye on the way the market acts in here. And then finally, we want to, I just want to point out that this bigger line here represents a slightly larger account. So I took the more conservative of the two, but there is even a slightly larger count than that to consider. That's a subject for another day. And with that, I want to say thank you so much for being here. Hope to see you on Wednesday for the Wyckoff market discussion. And please check out the most recent power charting. Take care, everyone, and see you next time.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.